folks. Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory in Birmingham. We thought we'd come to you today with a little bit of an update on the markets. The S&P 500 appears to be hanging out right below that 4,200 level that we've been flirting with now for the past couple of days. We took a little bit of a nosedive yesterday, or really in response to the announcement that the Biden administration would be seeking a 40+% tax rate on long-term capital gains. And then in the day following, we saw the market sort of shrug it off and rebound right back up, which highlights really the futility of trying to time these daily movements in the market. Which is a topic that we've beat to death in previous videos, so we're not going to beat it anymore in this one. What we are going to talk about a little bit is that capital gains tax plan, because it certainly made a lot of headlines in the financial press yesterday. A lot of the media just sort of, I guess, stirring the pot a little bit. So let's talk about what it means and what it might not mean. So certainly on the margin, this may impact longer-term investors by what I like to call the Warren Buffett problem, okay? So Warren Buffett famously owned shares of Coca-Cola. He's owned those shares since the beginning of time. And so his capital gain in those shares, or more importantly, his firm's capital gains in those shares are quite high. Maybe they're 50% of the position's value, okay? So if he has to pay a 20% capital gains tax rate on the 50% gain that he has in the stock, 20% of 50% is 10%, so he's effectively selling shares at 90 cents of their value. And when asked why he may not want to sell Coca-Cola, he will look at people and say, well, I don't believe that it's selling at a 10% discount to its fair value, or it's trading at a 10% premium to its fair value. So it doesn't make a whole ton of sense for me to sell it right now and pay the taxes. I'd rather just hold on to it and watch it continue to appreciate. So certainly there are certain investors that if the tax rate moved higher, that problem would become even worse and would provide a disincentive to sell. However, we'll talk a little bit about the types of firms and types of people that might face that problem, because it's not everybody that you might think. The second types of people that might be impacted by this are entrepreneurs and business owners, anybody who's built a business. If they look to sell, the family business for a couple $1 million, then they would have to pay income tax rates or capital gains tax rates that are a lot higher than they currently are. I'm sure that there will be an army of accountants and tax professionals that are out to figure out some way to game the system and make it so that you don't have to pay 40 or 45% when you sell your business. And lastly, I think there are hedge funds, private equity vehicles, venture capital vehicles that currently most of the participants in those vehicles, including those who manage them, pay taxes as capital gains instead of paying them as income. I think that those individuals might get hit by this tax in a way that most of your mom and pop individuals on the street, most of Main Street, won't have to pay. In terms of what it won't impact, short-term traders, anybody who's kind of in and out of the market, moving around. I buy Amazon one day, I sell it the next day and buy Google. Those types of, high-velocity types of traders that we've previously discussed in maybe a little bit of a negative light on some of these podcasts. Those people won't get impacted because they're already paying the top tax rate that they possibly can, and so a change in the long-term tax rate won't matter all that much to them. And then the last thing that I think has been largely not covered by the media is that the top tax rate for cap gains really won't kick in unless you are reporting $1 million or more in income. So, for most of our retirees out there, you got to have a pretty sizable net worth before you cross the $1 million a year of net income or income on your tax return to be able to actually even qualify to pay that tax. And it's not clear from the proposal. Keep in mind, we don't have a full proposal. We just have rumors of a proposal. It's not clear from that when it would actually start to tier in. But my guess is that there's no move by the administration to really penalize a lot of the savers that are looking to withdraw, even a couple $100,000 a year out of their retirement accounts to fund their retirement. This is really more, once again, a tax targeted at the ultra wealthy, which is candidly not a place, at least from an income level, that a lot of our retirees fall. So I think it's once again a little bit of an example of what we've talked about a number of times on the podcast in terms of it just being a little bit of clickbait for the media, right? It's very easy to fire people up. Oh, your taxes are going up. You're a saver. You save money. You're going to be paying taxes at 40%, not 20%, and let's get all angry about it. Where when you really look at the details of the program, it applies to a very small number of folks. And if you're in that camp, then yes, it's certainly a problem. But for the vast majority of the people that are watching this podcast, it really probably won't be an issue. With that, as always, if you ever have any questions, please feel free to reach out to myself or to your advisor. I hope you're having a great day, and I look forward to talking to you again soon.
Are you enjoying this content? Please subscribe to our YouTube channel or follow us at RFG Advisory on Facebook, LinkedIn, and Twitter. Thanks.